Hi guys, welcome back to the channel. My name is Dave, and today we're talking about the Iron Condor. I know, you're having flashbacks right now to the 80s hair bands like Van Halen and Def Leppard and Iron Condor. Wait, no, that's not right. It's an option strategy. But the cool thing about it is it's a market neutral option strategy, which is kind of what we've had over the last 12 months, right? We really haven't gone anywhere. So if you've been short or long the market, maybe if you're in the right stocks, you've done okay. But in general, we haven't really gone anywhere. Likewise, if you're just sitting in cash, you are collecting some cash, but we could be in cash and also deploying things like the Iron Condor. So today we're going to talk about how this can generate some cash for us in a neutral market. If that is what you're looking for, please stick around. Whoop. So first off, what is an Iron Condor? Well, it's a defined risk option strategy that we should be using when we're not bullish or bearish, but we're just kind of market neutral. If you think about the last 12 months, I mean, that's what we've been in, right? The S&P really hasn't gone anywhere. We've been stuck in this trading range. So if you look at SPY, for example, we've gone from 357 to 430, kind of bouncing between that range. So I would say for part of your portfolio, having market neutral option strategies like this being deployed can pay off really nicely. So let's start out by looking at our classic diagram and jump in and see how this thing gets deployed. So we're gonna start with world famous stock XYZ, which is always conveniently trading at $100 when we're doing these different diagrams, right? So we're gonna deploy our Iron Condor, which is simply a credit spread in both directions. Now, if you're not familiar with credit spreads, if you're not familiar with buying and selling puts and calls, I suggest you go watch this video that I'll link above, which starts with those basics. And I also have a video that I'll link above on credit spreads. And there's one in there if you go looking for debit spreads as well. So having kind of a working knowledge of that is really going to pay off as you move through this. So if you're brand new to options, start there. But now let's get back to this. Now, if you are not used to these diagrams, we have a profit and loss on this axis and a stock price along this axis, okay? So we could, for example, in this diagram, sell a call at 105 and go out further and buy a call at 110. That gives us a credit spread, right? That's a call credit spread. That gives us one wing of our Iron Condor. Now the second wing could be selling a put at 95 and going further out and buying a put at 90. So since we're selling that put closer and going out farther and buying a put, that gives us our second credit spread. Again, if this is confusing, go watch the introduction videos. Now, in this example, we're collecting $100 for each wing in credit for a total of $200. $100 per side, total $200. That goes in our pocket right now when we execute the trade and time starts ticking away. So right now, we're up $200, right? Now, what could happen at expiration? And that's what this diagram is about, right? With our defined risk trade here, what can happen? What's the best thing? What's the worst thing? Well, as long as we stay between the two sold options, we would make max profit because everything would expire worthless. Simple enough, right? Stay between these two sold call and put, and we keep all $200, everything expires worthless. Now, if the stock price reached either of our long options, those are the options we bought at 90 and 110, we would have a max loss of 300. Now, how do we get to that? Why? Well, the math would simply be the difference between the strikes, right? So let's use the 95 and the 90 on the put options on this side to get $5. And it would be the same on the other side. So $5 times one contract, which is what we sold, or 100 shares means a $500 loss. But we collected $200 up front, so we have a $300 max loss, right? So we've defined our risk. Collected $200 up front, the most we can lose is $300. And finally, our break even would be where we give up our $200 of credit that we received up front. So a 2-point move in either direction past our short call or put would give us those break evens of 93 and 107. Make sense? So our defined risk trade is now set up and we let time start to tick away. Now, these benefit from a lack of price movement. So if it stays between those two short strikes, that 95 and 105, we're going to be doing pretty darn well. And I will typically close these out when I get to 40, 50, 60, 70% of the max profit. I'm going to get out. I rarely will ever see expiration on an Iron Condor. I want to take my profits and run for the hills and set up a new trading range for my next trade. Okay, and you can layer these into. It can work quite well over a period of time. Now, these are theta positive, so they benefit from time decay, and vega negative. So we want declining volatility or a period where there's high volatility, set it up, and then we're hoping for a decline in volatility. Now, low volatility, like what we have right now, is okay as long as it continues to stay low or decline, then we can benefit from that as well. But yeah, right now the VIX is around 17, so we are pretty low. So, I don't think you have to be super aggressive on your IRON Condor right now because you're not going to receive as much credit, and then you're counting on it to stay low going forward. And just to show you what this might look like, I'm going to use Fidelity, which is where I do most of my option trading, but honestly, when it comes to things like IRON Condors, it doesn't handle them that well. I prefer some other platforms, and I'll show you what platform I've been looking at recently here in the near future so that I can subscribe. But with SPY at 412.63, you would simply select IRON Condor here at Fidelity, and it will start filling in your 4 legs. So we got our sell to open, buy to open, right? This is our call credit spread, and then on the other side we got our put credit spread. So we're right in the middle here at 412.63. We're going to sell above at 425 and out to 430. And then below 395 and 390. So on both of these, we have $5 between here and here. So we know that means our max loss is $500 minus the credit that we're going to receive, which looks like it's $262 right now for this trade, the way we have it set up, which means we'd have a max loss of about $238, just like the sample we kind of ran through earlier, and we'd see our break evens of 392 and 427. That's what we need to maintain between these 2 points in order to make some profit on this trade. So that's how it would lay out in Fidelity, just as an example. Now this is the option chain for that particular trade, and I picked an expiration date of June 30th in that example, and I tend to go a little bit longer with my IRON Condor, so that's 55 days till expiration. So I'll go anywhere from about 4 to 8 weeks, usually around that 5 or 6 week period. But I also do some shorter ones, but I always feel like I'm at the mercy of a few bad days there, so I tend to like to give myself a little bit more time here. So I'll usually go out, like I said, 4 to 6 weeks, 4 to 7 weeks, somewhere in there when I do an IRON Condor. Now I picked the 395 strike on the put side, which gives me a delta around 26. And on the call side, if we go down to the 425, we're sitting at around a 31. So I am a little skewed on that particular trade, if you think about it in that sense, towards the put side. So it's a little bit more of a bearish setup, I suppose. But yeah, that's just a quick look at the option chain. And here's an example of an IRON Condor, again with Fidelity, utilizing SPY. So in this case, I broke my own rules, the things I just told you about. One, I held it almost all the way to expiration because I closed this down on April 11th, and it expired on the 12th. So not something I typically do, and it's also a short duration trade. I was only in this for about 2 weeks, but figured this was kind of unique, so I'd kind of use it as an illustration. But I started this actually out with just a credit spread, right? On 331, I sold my 414 and I bought my 418 call. Then I added my second wing, turning it into an IRON Condor a couple days later on 4.4 when I added my 401 put that I sold and I bought my 392 put, putting myself into an IRON Condor. Now, that's fine, and I kind of like that and wanted to illustrate it because it just shows you the flexibility of these types of trades. So now fast forward a few days later, and it's April 11th, and I'm shutting this down, and SPY is at $410 a share at this point. So on this side, with 5 contracts bought and sold, I made just $100, right? $376 for the ones I sold, but I lost $273 for the ones that I bought. Made about $100, just over $100 on this side. And on my put side, I made $421, but I lost $153. So made $268 there on this side. So altogether, about $370? Some nice pocket money for a trade like this over about a 2-week period. So again, something that I just enjoy showing to and illustrating. They're not always going to be winners, but having some of these market neutral type of trades can put some money in our pocket when nothing is going on. Now, I recently did a trade with XLI, that's the Spider Select Sector ETF based on the industrials, and I learned a couple of things from that particular trade. One, it reinforced the idea that I will not do IRON Condors unless there's lots of open interest and lots of volume. So it makes it really difficult if your bid and ask spreads are extremely wide. So look for lots of volume. You want tight bid and ask spreads that'll really help you manipulate these types of trades when you're in an IRON Condor. So look for a volume and open interest. The other thing is I did 10 contracts. By the time you buy and sell puts and calls at Fidelity, that cost me $23 to open up that trade. So I will not be doing any more like that as well at Fidelity. I will probably be using a new platform. And if you want to find out what that platform is, please like and subscribe because I've got a lot of great content coming out about that particular platform. And finally, I don't always open up an IRON Condor. Sometimes I start out with a credit spread and becomes an IRON Condor. I add the second credit spread. And sometimes I start out with an IRON Condor and I clip a wing, take it right off, and it becomes a credit spread. So you can manipulate these quite a bit and use that to your advantage depending on what your goal is and how you see this thing playing out. So if you like this type of content, please like and subscribe. If you have any questions on any of this, please ask down below, and really appreciate you watching. Have a great night. Take care. Whoop.